Hey guys, I'm here with Michael Plaks, internationally renowned
International.
CPA and tax expert. And today he wants to cover the four most important things you need to know if you're going to flip a house relating to taxes and finances. So go ahead and take it away, Mike.
Okay, thank you, Chris, for having me here, and thank you, Brant, for inviting me to be part of your event. What we're talking about here are tax applications of being in the business of flipping houses. And before I talk about that, just a few words is why am I talking about that? Is I'm an accountant. My business is preparing tax returns and giving tax advice to business people, and I specialize in real estate. All of my clients, I work exclusively with real estate investors since 1996. Now, flipping obviously is a very lucrative and profitable way to run your real estate business nowadays, but it has specific tax implications that for people who are new to that business is sometimes confusing. So what I would like to start with, Chris, is just the basic how it would work on an example. So let's say you are buying a house, and right now for simplicity we will ignore financing. Let's assume that everything is cash, because for IRS tax return essentially everything is presented as if the whole cycle of business was done in cash. So let's assume that you buy a house for 70 grand and there is a 30,000 you put in repairs, labor and materials. So your total money put into the deal is 100. You have 70 plus 30 in rehab, and you sell house for 140. Now I will ignore holding costs, closing costs, all of those things which of course matter, just to oversimplify the example. So you put 100 into the house, you sold it for 140, you put 40,000 in your pocket. That is before business overhead. Again, I'm oversimplifying. Just as an example, let's assume you have just one deal, there is 40,000. Question I get all the time, so is it short-term capital gain, is it long-term capital gain? It's neither. One thing very critical to understand, it's not capital gain at all. That is called business profit, and it has two taxes that come with it. There is income tax and self-employment tax. Self-employment tax represents Social Security and Medicare tax. Combined, they can hit you anywhere from 15 to 40%. That's a huge range, I'm saying. 15 to 40% obviously is a very wide margin. So for your rule of thumb, if you just want to have an idea, I would say take 1/3. So if you made 40,000 on that deal, 1/3 of that roughly you would want to set aside for future tax liability. So you take 1/3 of 40,000, okay, we're taking, give or take, let's say 15 grand. Yes, that's how much of your profit can be eaten by taxes in a normal transaction. Now, if you have overhead expenses, which everybody does, it's your using your truck for business, it's buying your computers, paying your lawyers, your accountants, buying supplies, all of that stuff. Yes, that will reduce 40,000 and reduce taxes paid there. But thing that I wanted to focus on is you pay tax on the net profit on the deal, which means when the dust settles, when you paid off everybody and everything. And that tax has double taxation, sort of. Income tax plus self-employment tax, which can go as high as 40%, but the safe number to target is about 1/3.
Okay, so I understand, that when you're doing that flip, you do everything, basically your net profit. So that's after all the expenses, all the things like your holding costs have been paid, your realtor costs, the taxes.
Absolutely. Right.
And does your money also count? So if you actually have a loan on the house, I know we did the example as cash. Mm-hmm. If you actually have a loan on the house, that's also an expense, right? So that's also deductible?
Yes, when I started talking about that, I said I will oversimplify by ignoring financing, but let me present it differently. Okay, if you paid, even with financing, you looked at your bank account before you started a deal. And then you looked at your bank account after the deal is finished. After you paid off financing, holding, your wholesaler, your realtor, whoever else was involved, paid absolutely everything. Paid me, paid Brant, paid everybody.
Absolutely.
How much more do you have in your bank account after that? When the dust settles, when everybody is paid. If you end up having 40, it's 40. If you end up making 20, because at the end of the day, the IRS taxes you on what you made on the deal. So whatever it is after all expenses and after overhead, such as, like I said, your equipment, your contractors, and everything else.
Okay, so there's a lot of deductions you can take on, I guess, because you said it's business income. What would you say the number one tax saving is? Like, what's the number one way to either, shelter or avoid taxes in general?
That is a great question, and usually when I receive that question, the question is phrased, okay, what is the best way to structure my business for tax savings? And the implication with that question is that the secret is in the way you structure your business. And people normally think as, what kind of entity do I have to have, an LLC, corporation, or what else to save on taxes? That's a valid question, but I believe that it's very much misdirected question. So I'm going to answer a question you, Chris, actually asked. What is the best way to save money on taxes? And that's not by creating entities. I'm saying that because you know what that question would be similar to. You are saying is okay, what is the best paint for my house, before the house is built? Okay, entities is a good thing. I don't mind addressing that a little later. Okay. But I want to start by talking what is the single most important thing in saving money on taxes. And that thing is as simple as it gets, but it's disregarded, unfortunately, even by the most successful investors that I'm working with. It's very simple. It's called keeping good records. And you can wave it all, it's like, oh yeah, blah. We heard that all the time. It's easy, everybody understands it. No, you kind of understand it. Let me clarify what I'm talking about. You come to me and just like we discussed, you finish a deal. I'm asking you, hey Chris, how much you spend on fixing that house? Do you have an idea on your most recent deal?
Yeah, absolutely.
Okay, give me how much you spend. Your typical answer.
My typical
Sorry for
answer,
picking on you personally.
Yeah. Okay, so the last deal we did, we bought it for $135, and we put about $65,000 in repairs in it.
Okay, can I stop you here?
Yeah.
You said the magic word that I prayed you would say, and you did. You said about.
Yeah.
You said about 65,000. Perfect. Okay. Like, let's say, okay, when you say about 65, and again, don't take it personally, that's not about you. I love that example because it came out of your mouth naturally, and I'm with you on that.
Yeah.
But that's what it means when you say about 65,000. What it really means, if you kept every single receipt and you totaled it, could it mean that you spend 66? Is it possible?
Oh yeah, absolutely.
Is it possible that you spend 70?
No.
So you think you're pretty close, right?
I know that the actual number is like 65,836, but I'd have to look it up to get an exact number for.
Okay, but let's assume. Okay.
Yeah.
Well, your answer is okay. You're making it difficult for me because you're saying you have the real number. But I will twist your example slightly by saying when you say about 65, and that means you might have been somewhat off. And when you indicated it could not be 70, you're saying is okay, you're accurate within 1,000.
Yeah.
Okay, now between us business people, would that 1,000 be a deal breaker?
No, absolutely not.
Absolutely not, right?
Yeah.
You bought house for 130, you put almost 17 repairs, we're talking 200,000 house, right? So 1,000, yes, it's important, it's money, but it's not a deal breaker. So somebody who works on that house can say, well, I did not keep necessarily receipts down to the last $50, so I may be 1,000 off. What's the big deal? Here is what the big deal is. Remember when we talked earlier about taxes, right? Just a few minutes ago.
Yeah.
Remember what I said your tax rate could be 15 to 40%, and I said 1/3 is an operating figure. So let's take 1/3. 1/3 of that $1,000 is $300, $330, whatever. So we have more than $300 there, which is potential tax on the 1,000. I'll put it two ways for you. One of them is maybe you spend that 1,000. If you did not track it, your actual cost of that 1,000 is 1,300. You spend 1,000, but now you're going to put another 300 on top of that out of your pocket because you did not keep it and you are going to miss the deduction. So instead of 1,000, you would pay 1,300. Now, you are a rehabber yourself, so very simple question to you. You are getting a bid for $1,300 for plumbing work on your project. Are you going to solicit another bid?
Absolutely.
Okay. How much time you would spend, and you're saying absolutely, how much time you would spend interviewing other plumbers who possibly can bring down your 1,300 cost of labor down to 1,000?
Yeah.
Okay, you know what I'm talking about, right?
Yeah.
You will spend some time, you will interview 3 people, you will spend your valuable time, and you will be able to drop it down by 300. Will you consider it a good day?
Yeah.
Yeah, you saved $300.
Yeah.
Then by not keeping that receipt, what you did, you just took that 300 that you spent time saving and threw it down the drain, completely useless, which will go to the IRS, not even to the contractor who could feed his family and like you more for paying him extra $300.
Yeah,
it goes to
absolutely.
Uncle Sam, so it basically goes in the black hole, nowhere to be seen. So that's why I'm saying, and $300 you would spend time saving as a business person, but by not keeping records, you might waste it. And that's why I'm saying this is the single most important strategy. No other trick in the business, no other structure will give you as much return on your effort as keeping good records. That's number one basic. Keep good records, everything else. And I don't mind talking about that, but
Yeah.
everything else will come after. After you have the foundation. Foundation, keep track of everything.
So you want to keep receipts on, receipts on any labor, any material, absolutely anything that went into that house.
Yeah,
and
correct.
then is there anything else you'd advise? Like, for instance, so you say it's small business tax. Well, do I keep the gas receipt that I paid for to drive out there every day and check it? Or is that something else? Entirely?
Remember when I didn't like your word about?
Yeah.
But now you said the word that I really like. You use the word everything. Everything is the answer.
Okay.
I wouldn't want you to keep receipts and records of absolutely everything you spend. Whether it's related, you said, on the property. Not necessarily related to the property. Everything related to the business. Because right now, okay, guys, you are watching this being at a seminar and you went out to have lunch. Now that lunch is something to keep track of because that was a business lunch. You were at a training, you spent $10 on the lunch right now. That counts. You may say $10, not a big deal. Remember again, you don't keep receipt, that lunch instead of $10 just cost you 14.
No,
So,
that makes total
absolutely
sense.
everything, yes.
Okay, and would you say, potentially, are there any pitfalls with taxes or things that people run into that surprise them?
Taxes is a pitfall.
Yeah,
right?
absolutely. Well, absolutely.
That whole thing is, but I like your question because you said, are there any pitfalls? Yes, there are multiple. Of course, I wouldn't be in business if it was that easy. But having limited time to talk about that, I would like to focus on just one. Okay, if I may, I will spend a couple minutes. There is one major mistake that can literally ruin your business. So if you were kind of paying half attention to what I was talking about up until now, I suggest everybody wake up right now and listen to this, because this thing can kill your business if you don't do it right, or in fact if you do it wrong. And what you do wrong is there is one big danger in doing flipping business. You cannot honor finance a flip deal. And I will repeat it one more time because it may sound contrary to what you heard somewhere else or contrary to what you believe it is. You cannot honor finance a flip deal. And I will explain right now why I'm saying that. It's not illegal. Of course you can do that. What I mean is it can kill you financially. This is why. The IRS rule on this issue is very black and white. Like, I'm wearing shades of gray. If you twist your camera around my office, you will see shades of gray everywhere.
Yeah.
I like gray. Don't get me wrong, I like gray. There are a lot of things in the tax law that are very gray. Now, this particular issue is not gray. It's black and white. And this is what IRS says. When you sell a flip property, at that point, you immediately owe taxes on the entire profit. And I stress that, immediately on the entire profit. So remember our example we started with, Chris. We talked like 40,000 you would put on your pocket.
Yeah.
So you sold that flip, you would owe taxes on the 40,000 now. And when I said my rate, I said up to 1/3, so we're talking 15 grand. So if you had that flip and you put 40,000 in your pocket on the flip, which by the way from people who are in Brant's training system is not unusual at all. So you can put 40,000 in your pocket and the IRS will expect 15,000 tax from you at that point. No matter, here is the problem. No matter whether you sold it for cash or sold on owner financing. And let's look at that again. At owner financing, you sold a deal and let's assume you got a 10,000 down payment with the balance paid over the next 5 years or however you structure that deal. It could be a good deal business-wise, I completely understand. If you count in your extra interest you make on financing and just the ability to sell the house quickly. All of that makes total sense. But remember that IRS will expect 15,000 this year on the entire 40, even if you received 10. Yes, even if you received 10. So here is what comes. On that deal, you may be collecting 10 as your down payment. That's all you collect this year. IRS does not care that you did not receive the rest of them. The IRS says, you owe 15,000 now. Do the math. Okay, you are getting 10 on the deal of actual money and 15 you owe to the IRS. You are upside down. I have seen people killed by that. Going into that unknowingly, not expecting that the IRS will want you to pay taxes on the entire profit right away. This is why I said before and I will repeat it again. On a flip deal, owner financing is extremely dangerous. If you do that, make sure that your cash flow supports that. If you do multiple deals and one of them is sold on owner financing, you will probably survive that. That's not a big deal. But if you are trying to do every deal owner financing, the tax bill at the end of the year is likely to come more than the money that you physically put in your pocket that year. So want just everybody remember and not fall into that trap while it's not too late.
Yeah, absolutely. So you're not saying no owner finance whatsoever. You're saying if that's all you do,
Correct.
you're going to end up paying more taxes than
yes, that's
than you
good
put in your
clarification.
pocket. Yeah.
I appreciate that. Yeah, I'm not against the idea in principle. I'm just saying that if every house you sell on owner finance, do your math and make sure that at the end of the year you will be able to cover your taxes. Okay. Otherwise, you may end up upside down without realizing that, and I have seen people falling into that trap.
Okay, and real quickly, is there any other trap or trick or any sneaky thing that people don't expect from the IRS that they run into? Like one other thing, if you could mention it.
One other thing that I could mention is basically how you report those sales on the tax return. Okay. Assuming that you do it yourself and not using professional help, somebody like me. Okay, if you do it yourself, I want everybody to keep in mind one thing. When the deal is closed, if you close it traditional way at the title company is likely to send to the IRS Form 1099 that tells the IRS how much you sold the house for. So in your example, like the house you were talking about,
yes,
right? It was 130. You bought it for, put 65 into that. Let's say 200. So I assume you sold it 250-ish, right?
We actually sold that at 280.
Okay, 280. So what the IRS will know that you sold the house for 280. So as far as the IRS concerned, Chris made 280 that year, and it was like, of course not. You did not make 280. I wish, but it was not 280. If you did 4 deals like that, the IRS will say you made $1 million. Like 280 times 4. Okay, you made $1 million. That's what we know about you. So When you report it on a tax return, you have to report the